Hello guys, welcome to another video. I'm AD from Pixel Profits, and in this video we're going to talk about fair value gaps. What are they? How do they form? What do they mean? What do they show us? How can we use them? And so on. So let's just get straight into it. So a fair value gap is a 3 candlestick pattern, and it's formed of a first candle. Let's take this one here. So this first candle comes up, has a wick to the upside, so forms a high, and then comes back down. We then have this second large expansion, or as it's often also called, displacement candle, where it pushes price strongly to the upside. Now the most important part of the fair value gap is the third candle right here. A fair value gap is a gap between the wick of the first candle and the wick of the third candle. So, as we can see, on this first candle, the wick ends here. And then there's a space where there's no wicks until we get to the third candle, we find the wick here. So between these two candles, there is a space on this second middle candle where the wicks don't overlap with each other. And that is where we draw our fair value gap. Now, if we look at something that isn't the fair value gap, if we look here at this first candle, we see the wick. And what do we see when we pass the second candle and we get to the third candle? Do these wicks overlap? Yes, they do. You can see that there, maybe just very slightly there. They overlap. So there is no fair value gap inside of this 3 candle pattern here. So you can see the difference, I hope. There's no gap here between the wicks, and here there's quite a large gap. Okay, so let me draw you another example. There's one right here. We go from the wick of the first candle, we go down to the third candle, and we draw to the wick of that. And there we have another fair value gap. Again, there is a gap between the first candle's wick and the third candle's wick. And that's what forms our fair value gap. Now, what are these? What do they mean? Well, basically, a fair value gap is an inefficiency or an imbalance in the market. What's happened, let's take this example, this green box here. What's happened is, after this first candle's closed, the new candle starts to form, and you can see there's no wick here or anything. It just pushes straight up. So that's a strong displacement move or expansion move upwards. Now, what that leaves behind in here, in this fair value gap, is a lack of the chance for buyers and sellers to get into their positions at a fair value, because the price has moved so quickly through this area that a lot of orders have been left behind and they haven't been filled. So those people weren't able to buy or sell at fair value. Now, where we see the wicks overlapping, as in our example over here, within this middle candle, there's been, a lot of buying and selling, and here and here, it's all overlapped. It's all balanced. But here, it's imbalanced. And what usually happens with these imbalances, in the end, is they come back to be revisited, like we see here. What I normally do, I like to draw my fair value gaps on the actual candle where the gap is here within this second candle. But it doesn't matter, you can draw them however you want. If you want to draw it like that, you can. I just find it easier to see where it sort of was formed. Anyway, price came back, tapped into our fair value gap, and then continued to the upside. Now, why have I drawn one of them as green and one of them as red? Well, we have bullish and bearish fair value gaps. Now, what that generally means is that in a trend, a bullish fair value gap, like this green one, will normally support price. And we can see that it did so here. And if we draw it out a bit further on, it also did over here, right? It came back into there and bounced. We got a nice reaction out of there. And this is a 4-hour chart. So obviously on a 1-minute chart, that's quite a large move, right? That's the number of points. But for now, we'll just stick with one time frame because we don't want to get too far ahead of ourselves. But imagine if you took a revisit of this fair value gap on the 1-minute chart, look for entry model here and took the trade out of there, it'd be quite a nice trade, right? Same with here, even better. Look at that. But we'll come to that later. For now, we just need to know that a bullish fair value gap should support price in an uptrend. Price is moving upwards, and we can see here, and I don't want to go too off topic, but we can see here that we get a big move down and move up. We get another move down, and then instead of making a lower high here and another low there, instead what we do is we come up, we break structure here. I've got videos on this, so you can go and check them out if you don't know what this is here. But basically what we see is a reversal pattern, right, to trend upwards for a while. So we expect then, with this large fair value gap that's been made, if we come back down to it now, that's a very, very likely area where we're going to revisit before we continue to the upside. So we can use the fair value gap as a good confluence for a trade idea, along with some other things. We'll come to that later. So in a trend, we expect, as we see here, that fair value gaps should support price in the direction of the trend. If we see price action with a lack of fair value gaps, like this section of price here, this sort of consolidation, if you like, here, then you can see that within this, there's no fair value gaps, right? Because the price is just ranging up and down, up and down. And so a lack of fair value gaps can show sort of indecision or a range. You can see the same thing up here, right? There's no real fair value gaps in any of this. See here, the price has been balanced, wicks are overlapping. So in a consolidation, there's usually a lack of fair value gaps. So we've already established that these inefficiencies often get revisited. So what can we say about that? Well, fair value gaps are like a zone on the chart, a point of interest. And you can see here, I've used the rectangle tool on TradingView, and all I've done is I have the middle line, and that shows us the 50% level of the fair value gap. Now that 50% level of a fair value gap is referred to as consequent encroachment. And that is basically just a fancy way of saying the middle. Okay. And what we use that consequent encroachment for is to judge whether a fair value gap is being respected or disrespected. What do I mean by that? We can see when we revisit this fair value gap here that price gets pushed out of it. So this fair value gap is being respected because the 50% level didn't get touched at all. Now, a touch of the 50% level is fine. If this wick was to come down and go through the fair value gap, then we still class that as the fair value gap being respected, as long as the body doesn't close past the 50% level. So if the fair value gap gets wicked, even all the way through, we still, if we move up and we don't close past the 50% or the consequent encroachment, then we say that the fair value gap is holding and it's being respected. And so we can see that that happens twice, here and here. The fair value gap's clearly being respected. We haven't even touched the 50%, right? But then on this third try, you can see that a strong candle comes down, actually creates a small fair value gap at its top there, which we can talk about in a moment. But the fair value gap gets closed completely through, not just the 50% level, but the entire thing. So now we have what we call an inverted fair value gap, or an inversion. And what normally happens with inversions is that where we originally expected price to come down into the fair value gap and be supported back to the upside, once the fair value gap becomes inverted like this, instead of offering support as we had in these two scenarios here, we expect the inverted fair value gap is going to actually act as resistance. And so we can see when we come back up into now, when we've closed below this and we start to come back up into it, we can see that we're not able to break above it now, here, here. And look, we get a reaction down and we come back up and retest it again and another reaction down. So I can change that to an inverted fair value gap now. I've just changed the color so we can see the difference. And what we now expect is that that is quite likely to act temporarily, at least, as a support flip to resistance. Okay, because it was acting as support before, but now it's been disrespected and broken through, mitigated, whatever you want to call it. It is now acting as resistance level, right? And you'll see that quite often on the chart. So while a fair value gap holds, it should support price in the direction of the current trend or leg of price action. But when it gets inverted, disrespected, closed through, then we see it act as a resistance level instead. So we have bullish fair value gaps, which is the green one here, and we have bearish fair value gaps, which is the red one I've drawn here. What's the difference? Well, I'd prefer to refer to them as bullish and bearish, but there is a more complicated name, which you might see, so I best mention it now, is BISI and SIBI. Now that sounds weird. What is that? Well, a BISI is a buy-side imbalance, sell-side inefficiency. And that is basically a bullish fair value gap. And a SIBI is a sell-side imbalance, buy-side inefficiency. For me, I don't hear many people using those. It's just a bit too much, to be honest. So bullish, bearish fair value gaps, right? Let me draw another one here, a bearish one. Now this one is large, and this is going to illustrate my next point. Types of fair value gap. Because not every fair value gap, as we can see by these three examples, is created equally, right? This one is huge compared to these other ones. And what we normally call that is a breakaway gap. Now with breakaway gaps, we can often expect that price will not revisit them immediately. So it was formed between this candle's wick here and this candle's wick here, right? So we can see that here we do come back up into it, and then we drop out, and then we come back into it here, but we get a consolidation area here coming up finally, and this is, many days later, to mitigate or to close above this consequent encroachment, this 50% level. And we would then say that this fair value gap is now used and we could ignore it. Now, if we just go forward a little, what we do see over here is that price does come back up into it. And if I draw out this high, price does try and come back up into it again for one more test to see if there's any orders left. But it doesn't even manage to come up and break, maybe come down. Because most of the people that are in here now with their orders have probably got out. It's already been rebalanced, right? Here. So a breakaway gap basically is probably going to get filled in the end. But before that, it's going to maybe, not always, but maybe result in being ignored for a while, where price just continues down because it's such a strong move. Or it might get revisited but cause a bit of a consolidation area that you can see here before it gets fully mitigated and closed through the 50% consequent encroachment. Now, another type we have is down here. I've marked a few other things here. I'll explain them all in a moment. But this one we might call a rejection fair value gap. You can see there's a tiny gap here between the wick of this first candle and the wick of the third candle, right? And that creates this tiny little bearish fair value gap. And what happens to it? It's so small, right? Because where we've pushed down strongly, we've immediately pushed right back up into it. And this wick that comes up has gone way, way back into this previous candle. So this is what we might call a rejection fair value gap. A small fair value gap where the third candle has come right back up into the range of the second candle and just managed to not reach the first candle's wick. What does that tell us? Well, it tells us that this is probably not the strongest fair value gap. A breakaway gap might not get revisited or retested for a while, might result in some consolidation, whereas a rejection fair value gap is likely to get run through sooner. And we can see that in the next candle, it gets inverted, right? Now, what did we say earlier about inverted fair value gaps? They often provide support. So when this fair value gap comes down and then gets run through, we could almost have anticipated that was going to happen because it was how weak it was. And then as soon as we get this close above it, it's likely now it's been inverted, right? So it's likely to now act as support, and price comes back down into it and off we go. And again, this is 4-hour chart, remember? So if you took a trade on this, on say the 1 minute chart, you'd get a decent trade out of that. And look, we come back down again, and ignoring anything else that's in here, we wick it again, and off we go to the upside. Okay, so breakaway rejection fair value gaps, two different types that might be worth you considering just when you're considering how likely a fair value gap is to work and that sort of thing. You can go and back test this and see for yourself and see how accurate you feel it is, but it's something worth considering. Now, fair value gaps are also used as what we call internal to external liquidity. What does that mean? Well, basically, if we look at this chart, we could say that the external liquidity is these highs and lows, okay? And price is going to do a few different things, but two of those things that it might do is seek liquidity between old highs and lows, or seek to rebalance inefficiencies in the market. And these fair value gaps are clearly inefficiencies. So sometimes what we'll get is we'll, for example, over here, we could say that price here has moved from internal range liquidity, so this internal fair value gap, it's come down, it's seeking external range liquidity, it's below these old lows, and then it's coming back up to seek liquidity again within, say, this fair value gap here. We can see there that what we've done then is we've gone from external liquidity to internal and bounced, and then we've come back down to more internal there, and then we've come back to internal, and then we've gone back to external and back to internal and back to external, and so on. And we've come back here, right, to internal. So disregarding everything else and just using fair value gaps and highs and lows, you can start to frame where you feel that price might be drawn to in the future by using fair value gaps as internal liquidity, so within a range of price, within the middle of price here. Then we can go from these fair value gaps, like here, for example, to the external liquidity that rests below these lows here. Now, something we need to make sure we're understanding as well is that there's three sort of main types of gaps, right? We've already talked about fair value gaps, but what we also have in this grey box here is what's just called a gap. You can see when I move it out of the way, there's a gap in price here. Now, this isn't so common, especially in liquid markets, but it can happen. You'll see this a lot in maybe stocks, shares, that type of thing. But in a liquid market like the NASDAQ, it's not so common, but it does happen. And this is just a gap, right? A gap between price. This is not a fair value gap. This is literally just a gap where no trading at all took place. Okay? So that's the difference between here, there was some trading, right? But it was just a quick move, whereas here there was no trading at all. Price literally jumped from here right up to there. So that's a gap. This is a fair value gap. And then we have a volume imbalance. What is that? Well, if we zoom in here, what we can see, let me just move that box out of the way. We can see here that when a candle closes, what we expect is that immediately after a candle closes, it should open a new candle at the same level and then move up, right? So this candle here has continued the bullish move that these candles have created. It's continued the bullish move, but it never started at the level it was supposed to at the close of this candle. So in between the close of this candle and the open, it should have been level, like in all these other examples that you see everywhere else, right? Closed here, opened there. Closed here, opened there. closed here, opened there, and so on. But here, there was a volume imbalance. And what happened was, there was trading here, eventually, but this second candle opened higher than the level of the close of this candle, which again is fairly unusual, but you will see them on charts. And again, it's another inefficiency in the market, right? All of these gaps, here's another one. There's a gap, there's a volume imbalance, you see that? There's no body overlaps here, like there should be, like here and everywhere. So when you see that, that's another area of interest which may get revisited and reused or rebalanced later on. Now, how can we use fair value gaps for trading? Well, we've already looked at the internal to external moves that we can see within this price action leg here. But what we can also do is we can use these fair value gaps on, let's say, the 4-hour chart that we're on now to see what price action is doing within them. So, for example, when we come up into here and we get this 4-hour candles coming up into this fair value gap, or coming back down into this one, we can look for trades within this 4-hour fair value gap on smaller time frames, like the 15-minute or the 1-minute, for example. And obviously within those 15-minute and 1-minute charts, there's also going to be fair value gaps within these fair value gaps, right? So you're going to get fair value gaps within fair value gaps. And what we can use those for is, let's say this is a 15-minute fair value gap, we can use that to refine our entry to get a better entry than using this entire big area here. Now, it's important that you pair fair value gaps with other confluences as well, your daily bias, for example, or whatever you use, really, trend lines, support and resistance, any other ICT, DTFX, God, whatever all this stuff's called, supply and demand. There's so many things now, right? But you can use these in any trading strategy to enhance it, to give you an extra confluence of where price might go. Because imbalances are likely to get rebalanced at some point, which gives you a draw on price, and it also gives you a nice reaction point to trade out of. What you can also do, of course, is overlap other points of interest, PD arrays or whatever you want to call them, other structures on the chart, other candle patterns, whatever it is that you trade. You can add those into these to make them even stronger, because if you have multiple things overlapping, then, for example, like here, you can just use the fair value gap concepts to say, okay, when price comes back to, so we've got this fair value gap here that gets inverted, right, by this huge fair value gap. What do we know about inverted fair value gaps? They often act as resistance or support, right? So where we expected this to act as support to push price up, it failed, and now we expect it to flip to resistance, which it did. So you can use fair value gaps and inverse fair value gaps together. You can use them on different time frames, and you can use any other tools, order blocks, anything you want with these to make them stronger and more useful. I think the video's been long enough, guys. We covered a lot of stuff in there that probably wouldn't normally be covered in one video. So I hope that's made sense. I hope that you can go and look for these now, mark them on your charts, and maybe use them in your trading strategies. And they will be a foundation of things that we'll talk about later on this channel. So hopefully you understand them. And if you have any questions, just leave them in the comments below. Okay, thanks a lot for your time, guys. Don't forget to like the video if you liked it, subscribe to the channel, hit the notification bell, all that good stuff that you normally do. And I hope to see you in the next one. Take care. Thanks for watching.